In this video, I'm going to explain what you can expect financially and economically once the Federal Reserve cuts interest rates, which is happening, and it's happening in about a week. So we're going to cover what to expect from the stock market, the real estate market, and from the job market and inflation. As always, my name is Derek, and I got my degree in finance, so you don't have to. Let's get started. On September 18th, the Federal Reserve will cut rates. And I said will cut rates, not might cut rates, because at this point, it's virtually guaranteed. The CME Watch tool, which tracks the probability of federal funds rate policy changes, gives the probability of a Fed rate cut, also known as a pivot, a 100% chance. So the real question is more so, how much will they cut rates by? Will they cut the federal funds rate by a quarter point or by half a point? And currently, the CME odds for those are 67% chance that they'll cut it by 0.25% and 33% chance that they cut it by 0.5%. Now, without dragging this section out too long, I do think that there's a higher chance that the Federal Reserve cuts rates by 0.25%. But I also think the market is underestimating the possibility that the Federal Reserve cuts rates by 0.5%. I think the odds of those two scenarios is probably closer, and that's because of the recent economic data coming in, which is already weaker than expected and is showing serious signs that the economy is slowing. Unemployment is already up to 4.2% when the Fed projected that to be at 4% even by the end of the year. So that's already higher than expected. Also, last month, the BLS, the Bureau of Labor Statistics, had to revise its created jobs number down by 818,000 jobs over the last 12 months. And the BLS had to revise that number again this month. And on top of all of that as well, Christopher Waller, who sits on the Federal Reserve Board of Governors, said that front-loading rate cuts may be appropriate.
Reducing the policy rate now is consistent, for example, with many versions of what are called the Taylor Rule, which suggests reducing the policy rate is appropriate given the data in hand.
Basically, starting strong with rate cuts and then slowing that pace over time to end up in the same place. Regardless of whether it's 0.25% or 0.5%, this September rate cut is just the beginning. There will be a long, probably multi-year path down to lower rates. And with that said, the question remains, what will happen to the economy? Let's talk about it, starting with the stock market. The stock market will go up over time, and lower rates will only help that. Now, I could end this section here because the stock market, like many other asset markets, is a rigged game. It must go up. And if you want the answer as to why that's the case, I have many videos covering that topic. The point is, the stock market will most likely, as the months go by, be positively affected by interest rate cuts. And we have historical data to back up that thesis. For example, here's a chart of previous Fed rate cuts. As you can see, while initially Fed rate cuts cause higher volatility in the market because people are emotionally driven and people do similar things when placed in similar situations. And here's the thing. As you look further after previous rate cuts, not only does the volatility calm down, but the chance of positive returns increases greatly. So much so that 3 years after the typical rate cut, there are only 2 instances where stocks were not higher. And 5 years after previous rate cuts, there are a whopping 0 instances where the stock market was not higher. And of course, whether there was a recession or not following that rate cut matters. But when you look at the averages, both the mean and the median return are highly positive, even just after 3 years, with 43% and 41% returns respectively. And the win ratio, the amount of times that you'd be in the green after 5 years, is 100%. Regardless of recession or not. So the takeaway here, while not financial advice, is that if you have money that you do not need for a minimum of 3 years, and definitely if you don't need it for 5 years and beyond, is that you're pretty safe investing in the stock market after a federal funds rate cut. And if the market dips at any point after the Fed pivot, buy the fucking dip. Better yet, dollar cost average the dip. And then simply forget about your account for at least a few years. Okay, now let's talk about real estate because the outlook here is less rosy or just as rosy, depending on where you're at. So, how will interest rate cuts affect the real estate market? Well, it'll affect it primarily through mortgages, although it may also affect it through increased supply. So, let's discuss. Mortgage rates are directly and indirectly affected by Fed policy changes. They are directly affected by bond purchases, which lowers the rates on longer bonds like the 10-year Treasury, which mortgages have a very strong correlation with. They're also indirectly affected simply because the lowering of the federal funds rate lowers short-term borrowing costs, which thus lowers most borrowing costs to some degree. The point is, mortgages will come down. How much? Well, we can look at the difference between the Fed funds rate and mortgage rates. That's known as the spread. And without getting way too deep here, what we need to know is the spread between the federal funds rate and the 10-year Treasury, because the 10-year Treasury is heavily correlated with mortgage rates, and that spread tends to be, give or take, plus 1%. But, as you can see here on this chart, there are instances where the 10-year Treasury return is below the federal funds rate, and right now is actually one of those instances. So, usually the formula would be the federal funds rate plus 1% equals the 10-year Treasury return. And then the spread between the 10-year Treasury return and mortgage rates tends to be anywhere between 1.5% and 3%. So you would add that on top. This would give you a rough approximation of the 30-year fixed. But because nothing matters and everything is fucked, and the economy isn't following a logical path currently, a more reasonable rough projection for the 30-year fixed rate mortgage rate would be the federal funds rate plus 1.5% all the way to plus 3% to come to that number. So now that we know all the mumbo jumbo, we can do some rough projections. The Fed funds rate is projected to be at 3% best case scenario by the end of 2025, which is really the beginning of 2026. So if that's the case, 3% plus 1.5% gives us a best case scenario of 4.5% for the 30-year fixed at the end of 2025 or the beginning of 2026. And it also gives us a worst case scenario of around 6% mortgages for that same 30-year fixed. So what does this mean? It basically means that mortgages will go down, which in turn means the real estate market will most likely keep going up. And this statistic right here shows why. For every percentage point drop in mortgages, 5 million more households can afford to purchase a home. That is a lot of new demand. But there will also be some added supply because lower rates will make it cheaper to build homes, and it'll allow rate-locked homeowners who want to sell their house but haven't been able to without losing their much lower mortgage rate from years ago to finally be able to do so. But it is my opinion that the added supply will not outpace the added demand. So homes will most likely, unfortunately if you haven't bought a home yet, and fortunately if you already have, continue rising in value. I'm just being honest with you guys. And by the way, actually, I have a very good video diving much deeper into this subject on the channel, but I digress. So with that said, let's now talk about the effects on the job market and inflation. Right off the bat, inflation will reaccelerate. That's almost a given. When rates come down, money across the board becomes cheaper. Cheaper to borrow, cheaper to use, and less incentivized to hold on to as savings rates and bond rates come down. So consumers will consume and demand for all things will go up. And companies will take advantage of that situation in one way or another. The real question is not, will inflation reaccelerate? It will. The real question is, how much? And that all depends on, one, how well of a handle does the Federal Reserve actually have on inflation? Two, how well agencies control corporate greed? And three, whether we enter a recession or not. Because a recession would cause lower rates faster, but it would also crush demand. And on the flip side, with lower rates, but us not entering a recession, inflation may accelerate too much or too fast, which would likely cause the Federal Reserve to pause rate cuts or even pivot again. Although that is unlikely because the US government quite literally cannot afford higher rates for longer. And that, of course, is thanks to our $35 trillion and growing national debt. Okay, and the job market? Well, that also hinges on recession. If we manage to avoid a recession, well then lower rates should ease some pressure on the job market. And while the numbers show a job market that currently appears strong, I think most people would agree that it really isn't and hasn't been as strong as the numbers suggest, which is probably why the BLS keeps having to revise its numbers downward. And on top of that, even for those who have a job, that job's wage needs to outpace inflation so that Americans don't effectively become poor. And wage growth is currently barely doing that. So then, will wages outpace inflation if inflation reaccelerates when rates come down? Well, employing companies will probably do everything in their power, as usual, to keep wages as low as possible while raising prices as much as possible, especially with inflation as an excuse. So, will wages outpace inflation if inflation reaccelerates? Probably not.